December. For most of the world, it's a time to kind of wind down. You've got the festive lights, family get-togethers, that feeling of closing the books on the year. But if you're like us and you spend your days watching the markets, December brings a totally different kind of energy. It's not an ending, it's more like a final test. While January feels like a clean slate, full of hope and new stories, December can feel like a vortex. It's this weird month where the normal rules, fundamentals, news, they just seem to bend. Capital flows in these strange, sometimes violent ways, and every single investor gets forced to face the raw mechanics of the market. So in this explainer, we're going to pull back that curtain. We're not just going to look at what happens, we're going to get into the nitty-gritty of why it happens. I remember the end of 2018 like it was yesterday. The holiday season was in full swing, but if you looked at the screens, it was a complete bloodbath. Bitcoin, which had been holding this key support level, just fell off a cliff. I mean, it dropped from over $6,000 to nearly $3,000. The US stock market was in an absolute freefall, its worst December performance in a decade. There was this crazy disconnect between the cheerful mood in the air and the sheer panic in the markets. And everywhere, I mean everywhere, from trading floors to online forums, people were asking the same question, a question that seems to pop up every few years. Why is December so red? And look, this isn't just about one bad year. This is a recurring thing, and understanding it is absolutely critical. Today, we're going to answer that question for good. Okay, let's just dive right into this, because this pattern isn't just a feeling, all right? It is etched into recent market history. Let's take 2015. The S&P 500 was just trading sideways, looked totally calm for weeks, and then bam! In the final days of the month, a massive fund sell-off just sent shockwaves through the market, wiped out gains, and caught everyone completely off guard. Then, of course, there's 2018, the year we just talked about, which was just a brutal, sustained sell-off that felt like a flashback to the financial crisis. And even more recently, 2021, we saw the crypto markets hit this euphoric peak, only to completely roll over and start a bear market, as liquidity, which is the lifeblood of any market, it just vanished into the holiday air. See, this isn't a coincidence. It's not some trader superstition. It's a structural feature of our market calendar. So, if it's not random, then what is really driving all this year-end chaos? Well, here's the key insight, the thing you have to understand. In December, the market's fate is rarely decided by the stuff we all spend so much time analyzing. Breaking news, economic data, what the Fed is saying. Nope. Instead, the market is at the mercy of two incredibly powerful and largely invisible forces. Think of them like deep ocean currents. While everyone's up on the surface watching the waves, these currents are what are truly dictating where the ship is going, and they often pull it in ways that seem to defy all logic. Getting a handle on these forces is the first step to navigating the storm. And here they are. These are the two forces we're talking about: tax loss harvesting and mechanical flows. So on one side, you have a conscious, strategic decision made by human beings. It's calculated, it's logical, and it's all driven by one clear goal: optimizing taxes. But on the other side, you've got something completely different. Mechanical flows are automated, they're unemotional, and they're executed by systems, by computers. They aren't driven by a goal, they're driven by a trigger. A preset rule gets met, and the machine acts instantly, without a second thought. You could say one is a chess move, the other is an avalanche. And the December volatility we see is born right at the collision point of these two very different types of selling pressure. So let's break down tax loss harvesting first, because it's really important to get the mindset here. This is not panicked selling. When a smart investor or a fund manager sells a losing position at the end of the year, they are not admitting defeat, not at all. They are actively making a financial calculation. They are crystallizing a loss on paper to generate a tangible tax asset, something they can use to offset the capital gains from their winning trades. It's almost like a form of financial alchemy. They're turning a red position in their portfolio into a direct positive impact on their year-end tax bill. This is a strategic move, made by the most disciplined players in the market. Okay, now let's talk about mechanical flows. This is a force of nature. It's like the ghost in the machine of modern markets. This kind of selling has zero emotion, no opinion, no story behind it. It is pure automated execution. For example, a pension fund's mandate might say it must hold 60% stocks and 40% bonds. So if stocks have had a great year, that fund has to sell stocks at year-end to get back to its target. It doesn't matter if they think stocks are going to go higher. The rules are the rules. Or, if investors pull money out of a mutual fund, that fund manager has to sell assets to raise cash to give them their money back. And then you get the real accelerants, stop-loss orders and margin calls, which trigger automatically when prices hit certain levels. It's just a relentless, unthinking force. So what happens when you have those strategic sellers from tax loss harvesting already putting some pressure on the market, and then this giant, unthinking machine of mechanical flows kicks in? Well, that's when you get what we call the mechanical cascade. This is the phenomenon where just a few small, rational decisions can trigger a completely irrational and self-perpetuating avalanche of selling. It's a chain reaction that, once it starts, is incredibly difficult to stop, mostly because it's no longer being driven by human decisions, but by automated rules. For a classic example of this, let's just rewind back to December of 2000. The dot-com bubble was still pretty inflated, though, yeah, it was showing some signs of strain. The popular belief was still that tech is the future, you can't lose. But as the year started to close, the market began to unravel, and fast. This wasn't because of some sudden change in the outlook for the internet. No, it was a perfect storm of these year-end mechanics. You had funds that were forced to sell to lock in historic gains, and they ran right into a market where other people were being forced to liquidate to meet margin calls, and the whole thing just started to feed on itself. The fundamentals hadn't changed overnight, but the flows sure had. You know, the Jenga tower effect is the absolute perfect metaphor for this. So imagine the market is this tall, kind of precarious tower of blocks. In step one, something happens. Let's say a large fund needs to meet year-end investor withdrawals, so they pull out a single block. The tower wobbles, but it's still standing. But that selling, that first block being pulled out, pushes prices down just enough to trigger the next level of mechanics. Suddenly, a wave of stop-loss orders get hit. That's another block coming out. Leveraged investors get margin calls and are forced to sell. And now, several more blocks are yanked out all at once. Each action triggers the next in a cascading failure until the entire structure just collapses into a mass sell-off. And all of this brings us to why December is the unique stage for this whole drama. It's the one month where all of these pressures converge into a perfect storm. You've got these hard, unmovable deadlines. Accounting books have to be closed. Investment funds have to calculate and report their final net asset value, their NAV, for the year. The window for making those tax loss harvesting decisions slams shut. And then, on top of all this pressure to sell, you have the critical factor of vanishing liquidity. The big institutional players, the market makers, they go on holiday. The market gets thin, it gets dry. In a deep, liquid market, a huge sell order gets absorbed pretty easily. But in the thin market of late December, that exact same sell order can create a crater. This leads to what is probably the single most important lesson for any investor to learn about year-end markets. In these specific conditions, the market doesn't need a fundamental reason to move. It doesn't need bad news. It doesn't need a change in outlook. All it needs is an imbalance in cash flow. When that relentless have-to-sell pressure from mechanical flows just overwhelms the wanna-buy demand from the few players who are left, prices will fall, period. It doesn't matter how great a company's prospects are. In the short term, cash flow is king, and it can completely overpower sentiment and fundamentals. Okay, so after hearing all of that, the logical reaction is probably a little bit of fear, right? It sounds like a chaotic, dangerous environment, a minefield you should just avoid. And you know what? For the unprepared investor, it absolutely is. But here is where we make the most important pivot in this entire discussion. For the investor who understands these mechanics, this environment is not a threat. It is the single greatest structural opportunity of the entire year. So right now we're going to shift our perspective entirely from one of fear to one of cold, calculated strategy. And there is no better guide for this mindset shift than Warren Buffett's timeless wisdom. I know this quote gets repeated so often it can kind of lose its power, but I want you to think about it specifically in the context of what we've just discussed. A market that is selling off because of forced, mechanical liquidations, not because a business is failing. That is the absolute definition of a fearful market. This is the exact environment Buffett is talking about. It's when great assets go on sale for non-fundamental reasons. And that is precisely the moment the informed, prepared investor becomes very, very interested. I mean, the ultimate case study for this is the fourth quarter of 2008. The entire global financial system was on the brink of collapse. The fear was something you could feel. People weren't selling because they thought a company's earnings were going to miss by a few pennies. They were selling because they had to. They were meeting margin calls. They were liquidating funds. They were selling anything that wasn't nailed down. It was the mechanical cascade on a historic scale. But investors like Buffett, who understood the difference between forced selling and fundamental selling, they saw what was really happening. They recognized that incredible assets were being thrown overboard, and they stepped in to buy with both hands, laying the groundwork for fortunes. So let's reframe our entire view of this. December is not simply a risk to be managed or a danger to be avoided. December is the market's final exam. It's a test. It's an annual event that brutally and efficiently separates the speculators, the ones who get tossed around by emotion and luck, from the professionals who have a map of those deep ocean currents we talked about. It separates those who get swept away by the flow from those who have learned how to use its power. So how do you pass this test? Actually, better yet, how do you ace it? How do you make that transition from being a victim of December volatility to a beneficiary of it? Well, it all comes down to having a clear playbook. I'm going to lay out 5 core principles for you, a strategic framework to not only navigate these conditions, but to actually capitalize on the opportunities they create. Okay, here's the framework. Number 1, observe liquidity above all else. Never forget how thin this market is. 2, follow, don't predict. Let the cash flows tell you what's really happening instead of just guessing. 3, if you have losses, plan your tax loss harvest like a pro. Sell with a strategy, not out of fear. 4, if you're going to bottom fish, if you're going to buy the dip, you have to do it with a systematic plan, not with emotion. And 5, the foundation for all of it, embrace patience. You have to understand that this is a temporary storm and new, clearer trends will emerge on the other side. Let's expand on that first one, because it's the most critical strategy. I want you to think of market liquidity as oxygen. When there's plenty of it, the market functions normally. It breathes easily. But during the holidays, that oxygen level drops dangerously low. Any sudden move, up or down, gets wildly exaggerated. The market is prone to these false breakouts and sudden collapses. These are traps. A professional trader understands this. They don't place big bets or make career-defining moves when the market can't breathe. They wait. They wait for the real money, the institutional conviction, to come back in January before they commit any significant capital. Now let's dig into strategy 4, because this is where fortunes are made, or lost. The art of buying the dip. Amateurs get this wrong every single time. They see a price falling fast, they feel that thrill of a potential bargain, and they just jump in with all their capital, trying to catch a falling knife with their bare hands. That's not investing, that's gambling. The professional approach is completely different. It's systematic. You figure out your price levels in advance, based on real analysis, not emotion. Then you deploy your capital in stages, in layers, as the price hits those levels. You're buying based on a predefined plan and on probabilities, not on a gut feeling or just hope. This table really just brings the entire concept home. It is all about the mindset. On any given day, both the amateur and the pro might be selling, but the amateur is selling driven by fear, the fear of more losses. The pro is selling driven by strategy, a tax loss harvest plan. Both might be buying. The amateur buys driven by hope, the hope that they've caught the exact bottom. The pro buys driven by probability, a systematic plan to scale into a position. And this is why their view of December is so radically different. The loser sees a dangerous threat. The winner sees an annual test of their skill. And that brings us to the ultimate truth of navigating volatile markets. A falling price on your screen does not mean you have lost. A drawdown in your portfolio is not in and of itself a failure. You only truly lose when you are operating in the dark, when you react instead of plan, when you're just a passenger to the market's whims instead of a pilot with a map. It's the lack of understanding, the lack of a framework for what's happening, that turns a temporary price decline into a permanent loss of your capital. Knowledge isn't just power in this game, it's your armor. So as we wrap this up, I want to leave you with this one final way to frame it. Think of December as the great filter of the market ecosystem. It's this end-of-year process that just shakes out the weak hands, the tourists, the people who were simply lucky during the year. It separates them from the strong hands, the skilled operators who have a real process. It is a challenge, absolutely, but for those who take the time to understand these mechanics, who build a strategy to navigate it, they don't just survive December, they master it, and they enter the new year as a more skilled, more confident, and ultimately a more profitable investor. If you take only one thing away from our time together today, let it be this 3-part mantra. Simply understanding these hidden cash flows gives you enormous power, an edge over most people in the market. Learning to follow those flows, to not fight the overwhelming current of mechanical selling, that's the key to survival. But learning how to leverage those flows, to use the forced, fearful selling of others as your own calculated opportunity, that is the path to true mastery. The December storm is coming, just like it does every year. But now you have a map. You know how to read the currents, and you're one step closer to not just surviving it, but learning how to ride the wave.